Accounts. Accounts are records of increases or decreases in specific parts of the accounting equation. So you can see the asset accounts, those are all things that are resources to the business. So cash, supplies, equipment, buildings, land, any of those resources that are classified as assets are accounts in the asset category. The liability account, each of these is something that the business owes. Most times you will see them something payable. So anything that the company has to pay in the future is a liability. Equity accounts represent changes to what the business owns. Typically, that will be owner investments, whether that's in the form of common stock, owner draws, and any withdrawals from the business from the owner. That can be classified as dividends. If dividends are paid to the owners, to the stockholders, that will decrease equity. And then revenues and expenses. Revenues will increase equity and expenses will decrease equity. So each of the file folders you see represents one account. Assets are resources of the company. So, like I mentioned before, that would be things like cash, land, buildings. This also encompasses what we call receivables. Receivables represent not cash, but amounts that will be received by the company in the future. Those are called receivables. This is a more detailed explanation of some of those asset accounts. So remember, asset accounts are resources owned or controlled by a company. Cash is not just dollars and coins, it also includes the checking account balance, so cash in the bank. Accounts receivable and notes receivable. Remember, anything receivable means that cash will be received in the future for that. But we have to go ahead and record it on the books in the financial records to tell the whole story about the business. So they will be receiving cash in the future for either accounts receivable, that is money owed to a customer, money owed to a company by its customers, or notes receivable, that represents money owed to a company from a loan that they made to another party. Prepaid accounts, we'll talk about those more in another chapter, but they represent prepayments of future expenses. So prepaid insurance, prepaid rent, etc. Continuing with asset accounts, supplies includes the cost of office supplies or store supplies. So any type of supply that is purchased to be used over time is considered an asset. Equipment obviously is the cost of the office equipment or store equipment. Buildings, obviously, they're the buildings that are used by the company. And land is the land owned by the company. Then we have our liability accounts. Liabilities represent anything that the company owns to another individual or another business. Typically, these end in the word payable. That is because the company will be paying cash in the future. And here's a detailed description of some of those liability accounts. Remember, these will often be payables. The company will be paying cash in the future for a liability that's recorded on its financial books. So accounts payable, those are promises to pay later. And accounts payable are typically from purchases from suppliers. So whether that's merchandise, inventory, equipment, anything that comes from typically a supplier will be recorded as accounts payable. Notes payable are loans. So if a company has a loan for a building or machinery, then that is represented on the books not only as the machinery or whatever it is that they have a loan on, but the loan itself is considered a liability and is recorded as a note payable. Unearned revenue and accrued liabilities, we will talk about those two more in a future chapter. Equity accounts represent any claims the owner has to the business. So these will be considered things like investments, any withdrawals. So any money that the owner puts into or takes out of the business. Common stock is the equity account that we use for corporations. So anytime an owner invests money in the business, they are issued common stock for that to show that investment. That is going to increase equity. Then any money that is taken out by the owner is considered a decrease to equity. And in a corporation, we call those dividends. And dividends decrease equity. So these two up here at the top, they represent anything put into the company or taken out of the company by the owner. The bottom two are revenues and expenses that are generated by the company. So revenues represent the money that is taken in from sales or providing a product or service. So revenues will increase owner's equity, while expenses, anything incurred or paid out, will decrease owner's equity. This is an explanation that I basically just gave on the previous slide to show you in the illustration, but here you can see the terms actually defined. So equity accounts are the owner's claim to any of the assets. Owner investment is when an owner invests in a company. So we see that in a corporation, that investment showing is common stock. Any owner withdrawals, so any of the money that goes out of the business to the owners. Typically we see that in corporations called dividends. Remember, common stock increases equity, dividends decrease equity. Revenue are the amounts received from sales of products or services. Revenues increase equity. And then expenses are the amounts paid out or used for cost of generating those sales. So the cost of providing products and services, and expenses decrease equity.